Welcome, curious minds, to another deep dive. Today, we're plunging into what might seem like incredibly dense territory, but I promise you it's packed with surprising insights and some truly actionable information. Our mission today, we're going to unravel the intricacies of the U.S. estate tax return, Form 706. Our listeners specifically asked for a detailed item-by-item explanation, really focusing on those critical wealth preservation methods, the ones that can make a huge difference.
That's exactly right. And while, yeah, the idea of estate tax might sound incredibly niche, understanding Form 706 is absolutely crucial for anyone involved in estate planning. Whether you're thinking about your own legacy, or maybe you find yourself stepping into that significant role of an executor, this isn't just about figuring out what gets taxed, it's really about understanding how strategic decisions, things like how you value assets, what deductions you take, which elections you make, can profoundly impact an estate's financial future. It's truly about preserving wealth for the next generation, making sure more of what you intend to pass on actually gets to your loved ones.
Okay, so let's unpack this right from the top. What exactly is Form 706, and why does the IRS even need it? What's its core purpose?
Okay, so at its core, Form 706 is the official document an executor uses to calculate the federal estate tax. That's the tax imposed by Chapter 11 of the Internal Revenue Code. And it's vital to grasp that this tax isn't levied on, say, individual shares that beneficiaries receive. Instead, it's on the entire taxable estate of the person who passed away. Think of it as a tax on the right to transfer property at death. It's like a snapshot of everything someone owned or controlled, its value, for tax purposes.
Yeah.
And beyond just the estate tax itself, Form 706 also plays a really critical role in figuring out the generation skipping transfer tax, or GST tax, specifically on what are known as direct skips.
Direct skips.
Yeah, those are typically transfers of interests in property included in the decedent's gross estate to what they call skip persons. Generally, that means individuals at least 2 generations younger than the transfer, like grandchildren or great-grandchildren, bypassing the immediate generation.
Okay, that clarifies the what. So who exactly must file this form? Is it for everyone or, just for the super wealthy? And what if you're below that line?
Right. Good question. It's definitely not for everyone, which is, good news for most estates. For people who pass away in 2024, Form 706 generally must be filed by the executor of every U.S. citizen or resident whose gross estate, and this is key, when you add in any adjusted taxable gifts they made during their lifetime, exceeds a certain amount.
And that amount is?
That amount is known as the basic exclusion amount. For 2024, it's pretty substantial, $13,610,000. But it's crucial to remember this threshold is adjusted annually for inflation. The IRS publishes the amounts for future years in their annual revenue procedures. So it's always moving, but yeah, consistently high.
13 million is quite high.
It is. However, and here's where a significant wealth preservation strategy comes in. Even if an estate falls below this taxable threshold, filing Form 706 might still be incredibly beneficial. Seriously. This is particularly true for electing what's known as portability of the deceased spousal unused exclusion amount, or DSUE.
DSUE portability.
Exactly. This can be a total game changer for surviving spouses. It could potentially shield millions more from estate tax down the line. It's a point many estates miss if they just assume, oh, we're under the limit, no need to file. Big mistake, potentially.
That makes perfect sense. Wow. Okay, this sounds like a lot of responsibility, especially for whoever gets tasked with handling it. What does it really mean to be an executor in this context, and what are their specific responsibilities, their liabilities, when it comes to this form?
Yeah, the executor role is significant. It's the individual, or maybe an entity like a bank, who is appointed, qualified, and legally acting on behalf of the decedent's estate. And it carries real legal and financial weight. If there's more than one executor, well, they're all ultimately responsible for the accuracy and completeness of the return that gets filed. And they're all potentially liable for any penalties if there are errors or, false statements.
So they all have to sign it?
Not necessarily sign, no. Typically, only one co-executor needs to sign the actual return. But the responsibility is shared. However, if they can't, for some reason, come together and file one complete return, maybe there are disagreements or fragmented knowledge, then each executor is actually required to file the return individually. In that case, each one has to disclose all the information they have about the estate, names of everyone with an interest, full property descriptions, the works. And critically, the executor who files a return must, every time, sign a declaration on page 1. It's under penalties of perjury.
Wow, penalties of perjury. That really underlines the seriousness.
It does. It highlights the executor's personal accountability. It's not just paperwork. Oh, and one more thing. If the return is prepared by a paid professional, like an accountant or attorney. That preparer also has to sign the return, fill out the paid preparer use only section, and give a copy of the finished return back to the executor. It's a joint effort for compliance.
Given those stakes, what happens if an error is found after the Form 706 has already been filed? How do you amend it? And what are the potential consequences or penalties for getting it wrong? I mean, beyond just fixing the mistake.
Great question. And yeah, it happens. Errors pop up. Values might need adjustment. If you find you need to change something on a filed return, the process is basically to file another Form 706. You need to clearly write supplemental information right across the top of page 1. You also have to include a statement explaining exactly what changed and provide any supporting documents for that change. And finally, you attach copies of pages 1 through 4 of the original Form 706 you filed earlier.
Okay, file another form, label it supplemental, explain the change, attach the old pages, and where does it go?
You'd mail it to the appropriate IRS Service Center, attention E&G. The exact address is always in the official Form 706 instructions for that year. Always, always check the latest instructions.
Right, got it. Now, about those consequences, penalties.
Yes, definitely consequences. There can be significant penalties for getting it wrong or filing late. First, there are late filing and late payment penalties. These can apply unless there's what the IRS considers reasonable cause for the delay. And here's an important tip. You should not attach your explanation for reasonable cause when you initially file the form,
Really? Why not?
because they won't consider it then. You have to wait until you actually receive a penalty notice from the IRS, then you send your explanation. Simply forgetting the deadline or relying on someone else who missed it, that's generally not considered reasonable cause.
Okay, good to know. What else?
Valuation understatement penalties, this one can really bite. If the value of property you report on Form 706 is 65% or less of its actual correct value, a 20% penalty applies to the resulting underpayment of estate tax, assuming that underpayment is over $5,000.
20% is substantial.
It is, and it gets worse. That penalty jumps to a staggering 40% if there's a gross valuation understatement. That happens if you value property at 40% or less of its correct value.
Ouch. So appraisals are key.
Absolutely critical. Thorough, professional appraisals are essential to avoid this. Imagine reporting an asset at $100,000 when it's really worth $200,000. If that value is less than 65% of the actual, you're facing that 20% penalty. And then there are return preparer penalties too. For paid professionals, penalties up to the greater of $1,000 or 50% of their fee can apply if they take an unreasonable position that leads to an understatement of tax. Ensures everyone's accountable.
Makes sense.
Couple of other practical points for filing. You always have to attach the death certificate. Always. And if the person died with a valid will, you need to attach a certified copy of that will too. Oh, and for convenience, you can choose to round off cents to whole dollars on the return and schedules.
Oh, that's helpful.
It can be. But if you do it, you have to round all the amounts. Consistency is key there.
Okay. Now, here's where it gets really interesting, especially for our listener focused on, proactive wealth preservation. Let's talk about strategies to potentially lower the taxable estate, starting with how property is valued. What's this alternate valuation? How does that give an estate a powerful lever?
This is, a really powerful area for potential savings.
Yeah.
Alternate valuation, it's under Section 2072 of the Code.
Yeah.
It basically allows the executor to choose to value the assets in the gross estate not as of the date of death, but instead as of 6 months after the date of death.
6 months later. Okay.
And if any property is sold, distributed, exchanged, or otherwise disposed of within that 6-month period, then you use its value on the date it was disposed of.
So you get a choice of dates, potentially.
You do, but there's a critical condition. This is why it's a strategic choice for tax optimization.
Yeah.
You can only elect alternate valuation if it must result in a decrease in both the total value of the gross estate and the sum of the estate tax and GST taxes payable.
Both have to go down.
Both have to go down. If it doesn't decrease both, you simply can't elect it. But think about it. Imagine someone passes away, and then boom, the stock market tanks shortly after. Or real estate values drop significantly.
Yeah, that happens.
This election lets the executor effectively capture that drop in value. It could potentially save hundreds of thousands, maybe even millions, in estate taxes by lowering the overall taxable base. It's like a tax-smart do-over if the market turns against the estate after death.
That's a fascinating way to handle market risk.
It is. And executors can also make what's called a protective alternate valuation election. They check yes on the form, write protective, but file initially using date of death values. This gives them flexibility. If final values, maybe after an IRS audit, make alternate valuation beneficial, they can potentially switch. It keeps the option open.
That's clever. Okay, what about special use valuation? That sounds even more intriguing, maybe more targeted, especially for families with like farms or businesses.
Yes. Special use valuation under Section 2032A is another incredibly powerful tool for wealth preservation, particularly for estates with family farms or closely held businesses. This rule allows certain real property used for farming or in a closely held business to be valued not at its fair market value, which might reflect its potential for, say, development, but rather at its farm or business use value, and that's often considerably lower.
So, valuing it based on how it's actually used, not its highest and best use potential.
Exactly. The potential tax reduction here can be massive for families trying to keep a farm or business going, keep it in the family,
Yeah.
but there are strict qualifying conditions. It's a very specific, targeted strategy.
Okay, what are the main hurdles?
All right, first, the decedent had to be a U.S. citizen or resident. Second, there have to have been material participation by the decedent or a family member in operating the farm or business. This has to be for at least 5 of the 8 years right before the decedent's death.
And material participation means not just collecting rent, I assume.
Definitely not just collecting rent. It implies active, regular, substantial involvement. Think making management decisions, doing daily physical work, advising on crop selection, that kind of thing, not passive oversight. Third, the property has to meet certain percentage tests relative to the overall estate value. At least 50% of the adjusted gross estate must be qualified farm or business property, and at least 25% must be qualified real property used that way. Ensures it's a core asset. And finally, the property must be acquired from the decedent by a qualified heir, like a family member who will continue that qualified use.
Lots of requirements. Is there a limit on how much the value can be reduced?
Yes, there is a cap. For decedents dying in 2024, the total value decrease under Section 2032A cannot be more than $1,390,000 compared to fair market value.
Still, over $1 million potential reduction is significant.
Very significant. And for valuation methods for farms, the main way is the annual gross cash rental method, looking at comparable land rents. If that's not available, net share rentals might work. If neither works, or if elected, you can use the method for valuing closely held business property, considering comparable sales of non-ag land nearby, away from development pressures. But here's a crucial step. To make this election stick, you must file a specific agreement.
An agreement.
Yes, the required agreement. It's in Schedule A1, Part 3 of the form. It has to be signed by every single qualified heir who gets an interest in that special use property. In it, they agree to be personally liable for any additional taxes if the property stops being used for its qualified purpose or is sold too early. They also have to designate an agent to deal with the IRS on this. Without this executed agreement, the election is invalid. No tax savings.
Wow. So getting all the heirs on board is critical.
Absolutely critical. And like alternate valuation, you can also make a protective election here, too, just in case the final numbers make it work. It involves a lot of hoops, yes, but the payoff can be huge for the right estate.
Definitely sounds powerful for preserving those generational assets. Okay, this next area, DSUE, you mentioned it earlier. It sounds like potentially an even bigger game changer for surviving spouses, maybe offering massive wealth preservation. What is this deceased spousal unused exclusion, or DSUE exactly, and how does it save potentially millions?
DSU portability is, yeah, it's truly a monumental planning tool for married couples. It came into effect for deaths after 2010. Here's the concept. If a spouse dies and doesn't use up their entire applicable exclusion amount against their own gift or estate tax, that unused portion, the DSUE amount, may be available for the surviving spouse's estate to use later on.
So the first spouse's unused exclusion doesn't just disappear.
Exactly. It can be ported over. This directly increases the surviving spouse's own exclusion amount, which, yes, can potentially save millions in estate tax when that surviving spouse eventually passes away. A huge deferral and potential avoidance strategy.
Can you give us a quick example? Numbers always help.
Sure. Let's say Jane passes away in 2024. Her estate is worth $5 million. The basic exclusion in 2024 is $13.61 million. So Jane used $5 million of her exclusion.
Leaving $8.61 million
That's
unused.
$13.61 million minus $5 million leaves $8.61 million unused. Now, if her executor makes the portability election, that unused $8.61 million isn't lost. It gets added to her surviving spouse, John's own basic exclusion amount. So John now effectively has his $13.61 million plus Jane's unused $8.61 million. That's a total exclusion of $22.22 million.
Wow, over $22 million tax-free potential.
Exactly, that he can apply to his own gifts during life or his estate at death. This is incredibly powerful. especially if John lives many more years, maybe his own assets grow significantly. It could mean zero estate tax versus a multi-million-dollar bill.
Okay, so how do you actually get this portability? How do you make the election?
This is the crucial procedural point. To unlock this wealth preservation tool,
Mm.
you must file a timely and complete Form 706 for the first deceased spouse's estate to make the DSUE portability election.
Even if that first estate isn't large enough to normally require filing.
Yes. Even if the first spouse's estate is well below the $13.61 million threshold and wouldn't otherwise need to file Form 706, you file it specifically to make the portability election. And timely filed means on or before the due date, including any extensions granted. Once you make the election, it's irrevocable. Can't change your mind later. And it's effective as of the first spouse's date of death.
So the surviving spouse can use it right away for gifts, potentially.
Potentially, yes.
Yeah.
For transfers after the first spouse's death.
How is the exact DSUE amount figured? Is it always the full unused portion?
It's the lesser of two amounts. Either A, the basic exclusion amount that was in effect on the date the first spouse died, or B, the first spouse's applicable exclusion amount minus their actual taxable estate. Usually it's the first one, but technically it's the lesser.
Are there any catches? Situations where it doesn't work?
A few important caveats, yes. The estate of a non-resident, non-citizen decedent cannot make this election. Also, you can't stack DSUE amounts. If a surviving spouse remarries and then that spouse dies, they can only use the DSUE from their last deceased spouse, not from multiple prior spouses.
Okay, only the most recent one. Can an estate choose not to elect portability?
Yes. If an estate files Form 706 but doesn't want portability, the executor just checks a specific box on the form to opt out. And if no return is required based on the filing threshold, then simply not filing Form 706 means you haven't made the election. It's a deliberate choice.
That's a profound strategic advantage for married couples. Okay, so we know who files and why and about these big strategic valuation and portability choices. But before we get to deductions, which everyone loves, we need to understand what actually makes up the gross estate. Can you walk us through the major categories? What does Form 706 want to see, item by item? What's included and why?
Absolutely. The gross estate is the foundation. It's the starting point for the whole calculation. It's basically the total value of all property interests the decedent owned or had an interest in at death, plus certain property they transferred before death under specific rules. And you must file the first 4 pages of Form 706, plus all the required schedules. That's Schedules A through I to back up the numbers you put in Part 5, the recapitulation section. It's really important. Complete all required pages and schedules fully. Returns with missing entries just won't be processed.
Okay, Schedules A through I. Let's break them down. What's Schedule A?
Schedule A real estate. Pretty straightforward. This is for all real property land, buildings, even property the decedent had a contract to buy but hadn't fully closed on yet. And the valuation here is key. You report the full value without reducing it for things like homestead or dower exemptions that might apply under state law.
So state law exemptions don't reduce the federal gross estate value.
Correct. Even if state law gives a spouse a homestead right, the full value goes on Schedule A for federal purposes. Appraisals are almost always needed here to support the fair market value.
Okay. Next,
Schedule B, stocks and bonds. Here you list all stocks and bonds. You need details like CUSENT number for publicly traded ones or EINs if it's an interest in a trust, partnership, or a closely held company. Valuation is critical again. For listed stocks, it's generally the average of the highest and lowest selling prices on the valuation date. Specific rules apply if there were no sales that day. Now, for stock in inactive or closely held corporations, family businesses, companies with few owners, little trading, you must attach detailed financial data, balance sheets, statements of earnings, dividends paid for the 5 years before the valuation date. This helps establish fair market value when there's no public market.
Okay, lots of backup needed for private company stock. What's Schedule C?
Schedule C, mortgages, notes, and cash. This covers mortgages and notes that were payable to the decedent, so where the decedent was the lender, plus all cash and bank accounts, checking, savings, money markets, certificates of deposit, etc.
Got it. Schedule D sounds like insurance.
Schedule D, insurance on the decedent's life. Exactly. You include the full proceeds from any life insurance policy on the decedent's life if those proceeds are receivable by or for the benefit of the estate. It also includes proceeds payable to other beneficiaries if the decedent held what are called incidents of ownership in the policy at death.
Incidents of ownership? Like what?
Things that show control over the policy. The right to change the beneficiary, borrow against the cash value, assign the policy, cancel it. It's about who controlled the policy, not just who got the payout. And insurance is broad, regular life insurance, death benefits from fraternal groups, even certain no-fault auto insurance death benefits could fall under this.
Okay. How about Schedule E jointly owned stuff?
Schedule E jointly owned property. Yes, this is for property held as joint tenants with right of survivorship, or tenants by the entirety. Generally, rule is the full value of this joint property is included in the gross estate of the first joint tenant to die.
The full value, even if someone else's name is on it.
Yes, unless you can prove that part of the property originally belonged to the other joint tenants, and they never got it from the decedent for less than fair value. For example, if a child paid for half of a house they owned jointly with a parent, using their own money, then only half the house's value would be included in the parent's estate. But you need proof.
Proof is key. Okay. Schedule F miscellaneous.
Schedule F, other miscellaneous property. This is the catch-all. Anything not reported on the other schedules goes here. Examples: debts owed to the decedent, other than notes on Schedule C. Interest in businesses like LLCs, certain Archer MSAs or HSAs if they don't pass to a surviving spouse. Also claims like tax refunds or pending lawsuits, rights like royalties, leaseholds, judgments, remainder interests. And this is where you'd report digital assets too. NFTs, cryptocurrencies, things like that.
Ah, digital assets go on Schedule F. Good
Yeah.
to know. Now, what's fascinating here, I've heard about discounts for some of these assets, especially business interest, maybe on Schedule F or B. Is that a legitimate way to reduce the value for tax purposes, a real wealth preservation tactic?
Absolutely. This is a prime example of a key wealth preservation strategy embedded within the valuation rules, especially for assets that aren't easily sold. For interests in closely held corporations, partnerships, trusts, LLCs, yeah, often reported on Schedule F or maybe B, you can frequently apply what are known as discounts for lack of control and lack of marketability.
Lack of control and lack of marketability.
Right. These discounts can significantly reduce the reported value of that asset for estate tax, which directly lowers the gross estate. For instance, say you own a minority interest in a family LLC. You might apply a discount for lack of control because, well, you can't dictate business decisions or force a sale on your own. Then you might apply another discount for lack of marketability because selling an interest in a private company is usually much harder and takes longer than selling, say, Apple stock.
So you could potentially stack those discounts?
You often can, yes. Let's say the initial pro rata value of an interest is $100. You apply a 10% lack of control discount, brings it to $90. Then maybe a 15% lack of marketability discount on that $90. That's $90 times 0.85, which is $76.50. So the value reported for tax purposes becomes $76.50. That's an effective discount of 23.5% from the starting value.
Almost a quarter of the value potentially discounted. That's huge.
It can be a vital wealth preservation tool for estates holding these types of assets. But, and this is crucial, the amount of the discount has to be based on specific factors for that particular interest and must be really well supported by professional independent appraisals. You can't just guess.
Right. Need that solid backup again. Okay, continuing with schedules. Schedule G transfers during life.
Schedule G transfers during decedent's life. Yeah, this schedule pulls back in certain property the decedent transferred before death, even if they didn't legally own it anymore. This is where the IRS often looks to prevent people from trying to gift away everything right before death just to dodge estate tax.
Makes sense. What kinds of transfers get pulled back in?
Okay, several types. First, property where the decedent kept a life estate, meaning they retained the right to income from it, or the right to possess or enjoy it until they died. This can even apply to informal arrangements, like, say, a parent gives a house title to a child but keeps living there with an understanding they can stay until death. That could get pulled back in.
Even informal understandings. Wow.
Yes. Second, transfers that only take effect at death. This applies if possession can only be obtained by surviving the decedent, and the decedent kept a reversionary interest. That's a right for the property to potentially come back to him or their estate, and that interest was worth more than 5% of the property's value right before death. Third, revocable transfers. Property where the decedent still had the power to change, amend, revoke, or terminate the transfer at the time they died, like changing beneficiaries. And importantly, if the decedent gave up any of these includable powers within 3 years of their death, the property is still included, just as if they'd kept the power.
The 3-year look-back rule.
Okay.
Schedule H powers of appointment.
Schedule H powers of appointment. This focuses on property where the decedent held a general power of appointment at death. A general power gives broad control. The holder can appoint the property to themselves, their creditors, their estate, or their estate's creditors. Even if a power lapsed, meaning the decedent didn't exercise it, it can still be included in the estate if its value exceeded certain thresholds, like the greater of $5,000 or 5% of the assets involved. Prevents avoiding tax by just letting powers lapse.
Tricky. Okay, last one of these inclusion schedules, Schedule 1 annuities.
Schedule I annuities, yes. This covers the value of annuities that are receivable by a beneficiary because they survived the decedent. But it applies only if the annuity contract was entered into after March 3rd, 1931, and the annuity was payable to the decedent during their life, or they had the right to receive it. If the decedent only paid for part of the annuity's purchase price, then only that proportionate part of the survivor's benefit value is included in the gross estate.
So based on their contribution.
Right. If the survivor gets $20,000 a year and the decedent paid 75% of the cost, then roughly 75% of the annuity's present value gets included. There used to be some old exclusion rules for certain pension plans and IRAs from before 1985, but those are pretty rare now and have very specific conditions.
Okay. That covers Schedules A through what goes into the gross estate. Phew.
It's a lot, I know. Oh, one final point on the gross estate, especially relevant for those smaller estates filing just for DSUE portability. If the total gross estate plus adjusted gifts is less than the basic exclusion amount, there's a special rule. For certain property that qualifies for the marital or charitable deduction, the estate doesn't have to report the exact value on Schedules A through I.
Oh, how does that work?
They can estimate the value within certain ranges provided by the IRS and just report that estimate in the recapitulation section. It simplifies things significantly, reduces the need for costly appraisals when no tax is actually due anyway. Big help for smaller estates seeking portability.
That's a really practical simplification. Okay, now for the part everyone really wants to know about. How do we reduce that taxable estate? This is where the real strategies for wealth preservation kick in, right? What are the major deductions? How do they shrink that taxable base?
You're right. This is where we shift from adding things up to subtracting them. Deductions are absolutely crucial. They directly lower the gross estate to get to the taxable estate, the number the tax rate is actually applied to. And just like with assets, you must complete and attach the right schedules to support any deductions you claim. They don't just happen automatically.
Okay, what are the key deduction schedules?
Let's start with expenses and debts. That's Schedules J and K. Schedule J, funeral expenses and expenses incurred in administering property subject to claims. Two main parts here. First, funeral expenses. You itemize them, burial costs, cremation, headstone, etc., and reduce the total by any reimbursements, like from Social Security or the VA. Second, administration expenses, things like executor commissions, attorney fees, accountant fees, appraisal costs. These are deductible if they've actually been paid or are reasonably expected to be paid, and they have to be allowable under local law. If commissions haven't been paid yet when the IRS examines the return, you need an affidavit saying the amounts agreed upon and will be paid.
Okay, funeral and admin costs. Is there a choice here about where to deduct some of these?
Yes. This is a critical strategic point for tax optimization. Most administrative expenses, executor fees, attorney fees can be deducted on either the federal estate tax return, Form 706, or the estate's income tax return, Form 1041.
But not both.
Generally not both. The executor has to choose where claiming the deduction provides the bigger tax benefit. This often requires crunching the numbers. There are a few exceptions. Certain taxes, interest, business expenses accrued at death can be deducted on both returns. But funeral expenses, those are only deductible on the estate tax return, Form 706, not on the income tax return. Making the right choice here is a classic example of where good professional advice really pays off.
Fascinating choice. Okay, what about Schedule K debts and mortgages?
Schedule K debts of the decedent and mortgages and liens. This is for valid debts the decedent owed at the time of death. Think credit card balances, personal loans, unpaid bills that existed right before they passed. If a debt is disputed or being litigated, you can only deduct the amount the estate actually concedes is valid. Generally, for claims based on promises or agreements, the deduction is limited to the extent the debt was contracted genuinely and for adequate financial consideration. Can't just deduct a promise to gift money. Although there's an exception for enforceable charitable pledges. Those are deductible if they would have qualified as a charitable bequest anyway.
Interesting. What about debts between spouses, maybe from a divorce?
Yes. Certain claims by a former spouse against the estate based on giving up marital rights can be deductible. Usually requires a written agreement about marital rights and the divorce happening within a specific time frame around that agreement. For property and income taxes, only taxes that accrued before death are deductible. Taxes on income earned after death, not deductible here. Mortgages and lendings get listed separately on Schedule K, and you need to link them to the specific property they're attached to on other schedules, like Schedule A for real estate. And here's a key detail. If the estate isn't personally liable for the mortgage, like a non-recourse loan where the lender can only take the property back, then you don't list the full property value on Schedule A and take a debt deduction on K. Instead, you only include the equity value, property value minus debt, on Schedule A and take no deduction on K.
Okay, treatment depends on whether the estate is personally on the hook for the debt. Got it. Now, the marital deduction, Schedule M, right? This seems like arguably one of the most powerful wealth preservation tools for married couples. How does it work? Is it really unlimited?
The marital deduction is, yes, incredibly powerful. Often, it's the reason there's zero federal estate tax when the first spouse in a married couple passes away. Section 2056 allows for an unlimited deduction for the value of property interests that pass from the decedent to their surviving spouse, provided, of course, that those interests were included in the decedent's gross estate to begin with, listed on Schedules A.
Unlimited, so potentially reducing the taxable estate to zero.
Exactly. In many cases, if property is structured correctly to pass to the surviving spouse, it can eliminate the federal estate tax entirely at the first death. It effectively defers the tax until the second spouse passes away. Think of it like hitting pause on the estate tax. This gives the surviving spouse huge flexibility and access to assets during their lifetime.
Are there any big limitations or exceptions to this unlimited deduction?
Yes, a couple of really crucial ones. First, generally the deduction is not allowed if the surviving spouse is not a U.S. citizen.
Ah, the citizenship requirement.
Right. Unless the property passes into a special type of trust called a qualified domestic trust, or QDOT, or is irrevocably assigned to a QDOT before the return is filed. We'll touch on that. The other big limitation is on what are called non-deductible terminable interests.
Terminable interests, meaning they end at some point.
Exactly. An interest that will terminate or fail after some time or based on some event. The classic example. Decedent leaves property to their spouse for life, with the remainder going to their children after the spouse dies. That life interest the spouse gets. It terminates on their death, and then someone else, the kids, gets the property. That generally doesn't qualify for the marital deduction on its own. The IRS worries this could let wealth skip taxation in the surviving spouse's estate.
Okay, but I feel like there's a way around that. This is where QTIP comes in, isn't it? What's QTIP? And how does it turn that non-deductible life interest into something deductible, offering that huge wealth preservation advantage by deferring tax?
Precisely. The qualified terminable interest property, or QTIP election, is the vital workaround, the exception to that terminable interest rule. It's a powerful strategy because it does allow tax deferral, even when the surviving spouse doesn't get full outright ownership. For property to qualify as QTIP, three main conditions have to be met. 1, the property has to pass from the decedent. 2, the surviving spouse must have a qualifying income interest for life.
Qualifying income interest for life, meaning?
Meaning they get all the income in the property, paid at least annually, and crucially, no one else can have the power to appoint any part of the property to anyone other than the surviving spouse during the spouse's lifetime. And the third condition, the executor must make a specific deliberate election on Form 706 to treat that property as QTIP.
And if they make that election?
The benefit is huge. If the QTIP election is made, the property is treated as if it passed entirely to the surviving spouse for marital deduction purposes. So it qualifies for the unlimited marital deduction, even though it's technically a terminable interest.
So it defers the tax?
Exactly. It defers the estate tax on that QTIP property until the surviving spouse's subsequent death. At that point, the value of the QTIP property gets included in their gross estate. This allows the first spouse to provide for the survivor financially for life, while still controlling where the property ultimately goes after the survivor dies, maybe to kids from a prior marriage, for example.
How do you make the election? Is it complicated?
Mechanically, it's straightforward. You make the QTIP election simply by listing the qualifying property on Part A of Schedule M and entering its value. The instructions basically say you're presumed to have made the election if you list it there and put in the value. And once made, irrevocable.
Okay, so listed on Schedule M.
Yeah.
Got it. Now, back to the non-citizen spouse issue. You mentioned QDOTs. How do those work?
Right, the Qualified Domestic Trust, or QDOT, election. This is the solution if the surviving spouse isn't a U.S. citizen, but you still want the marital deduction. The deduction is available, but only if the property passes to the non-citizen spouse within a QDOT, or is assigned to one before the Form 706 is filed. The main purpose of a QDOT is basically to ensure the IRS can collect the deferred estate tax later on, either when the surviving spouse eventually dies or if principal is distributed out of the trust during their lifetime. with some exceptions.
So it's like a security device for the IRS.
In a way, yes, it ensures the tax eventually gets paid. Like the QTIP election, the QDOT election is irrevocable and made by listing the QDOT or its value on Schedule M and claiming the deduction.
Okay. Another way to reduce the taxable estate is charitable giving. Schedule O, I think. What kinds of gifts qualify for a charitable deduction? And I also heard about something special for land conservation.
Yes, charitable giving is definitely a highly effective way both to reduce the taxable estate and support causes important to the decedent. On Schedule O charitable, public, and similar gifts and bequests, you can deduct transfers to a variety of qualifying organizations. This includes gifts to the U.S. government, any state or local government, as long as it's for exclusively public purposes. Also, gifts to corporations or associations organized and run exclusively for religious, charitable, scientific, literary, or educational purposes. Think museums, universities, churches, certain foundations. Also includes groups fostering amateur sports or preventing cruelty to children or animals. But there are strict rules. None of their earnings can benefit private individuals, and they can't be heavily involved in propaganda, lobbying, or political campaigning. The deduction also covers certain transfers to trustees, specific fraternal societies, veterans organizations, and even certain employee stock ownership plans. ESOPs.
Seems broad, but with important restrictions. Is there a strategy around maximizing this deduction?
Yes, a key point for maximizing the benefit is understanding the deduction is limited to the amount actually available for the charity to use. This means if, according to the will or state law, any estate taxes, GST taxes, or other death taxes have to be paid out of the charitable bequest itself, then the amount you can deduct is reduced by the amount of those taxes.
So the taxes can eat into the deduction.
They can. It creates a sort of circular tax on the tax calculation sometimes. So careful planning, like drafting the will to specify that taxes should be paid from non-charitable parts of the estate, is really important to ensure the full intended gift translates into the full deduction.
Good planning point. Now, about that special land conservation thing, Schedule U.
Yes, this one is really interesting and often underutilized, but incredibly powerful for landowners focused on conservation and wealth preservation. The qualified conservation easement exclusion, reported on Schedule U, is unique because it's an exclusion, not just a deduction.
Exclusion versus deduction, what's the difference again?
Yeah. An exclusion means the value is removed entirely from the gross estate calculation right at the start. A deduction reduces the gross estate after it's been calculated. Exclusions are generally better as they reduce the base earlier. This exclusion allows a portion of the value of land that's subject to a qualified conservation easement to be completely removed from the gross estate. It's an amazing tool for preserving family land, protecting natural resources, and getting substantial tax relief.
Okay, what makes an easement qualified for this exclusion?
It has to meet the definition under Section 170H of the tax code. Generally, it means a contribution of a qualified real property interest, like the entire interest in land, minus mineral rights perhaps, or a remainder interest, or most commonly a perpetual restriction on how the land can be used to a qualified organization like a land trust or certain government agencies. And it must be exclusively for conservation purposes.
And conservation purposes are?
Things like preserving land for public outdoor recreation or education, protecting natural habitats for fish, wildlife, or plants, or preserving open space, like farmland or forest land, either for scenic enjoyment or under a clear government conservation policy, provided it yields a significant public benefit.
So it's about permanent protection with public benefit. How do you claim this exclusion?
The election has to be made on a timely filed Form 706, including extensions. You file Schedule U with all the required details. Then you exclude the applicable value directly on Part 5, the recapitulation, line 12. Now here's a critical detail. You normally have to reduce the land value subject to the exclusion by the value of any development rights the donor retained when they granted the easement.
Retain development rights, like the right to build houses later.
Exactly. Rights to use the land for commercial purposes, not directly supporting its farm use, like building houses or commercial buildings on the conserved land. However, you don't have to make that reduction if every party with an interest in the land signs an agreement to permanently extinguish those retained development rights. This agreement has to be filed with the return. It needs clear consent from everyone involved to extinguish the rights, and they agree to be personally liable for extra taxes if they don't follow through within 2 years.
Another agreement needing everyone's signature. Seems common for these special elections.
It is. It ensures everyone's committed. For valuation, the value of the easement itself is usually the difference between the land's fair market value before the easement and its value after the easement, varied as of the date of death. It's complex, yes, but for the right property, the tax savings can be enormous.
Okay, we've covered inclusions, schedules AI, and deductions exclusions, J, K, M, O, U. What about credits? You said these are even better because they reduce the tax owed directly dollar for dollar, right?
Exactly. Credits are the final step in shrinking the tax bill. They come into play after you've calculated the tentative estate tax based on the taxable estate. They provide a direct dollar-for-dollar reduction in the actual tax due. Incredibly valuable.
What are the main credits available on Form 706?
Okay, let's look at two important ones. The foreign death tax credit and the credit for tax on prior transfers, Schedules P and Q. Schedule P credit for foreign death taxes. This credit is allowed for estate, inheritance, legacy, or succession taxes that were paid to a foreign country. To qualify, the property on which those foreign taxes were paid must also be included in the U.S. gross estate, and it has to be considered situated in that foreign country. Basically, it prevents double taxation on the same asset by different countries.
So if you own property abroad that's taxed there and here.
This credit can help offset that. The executor can claim whichever credit is more beneficial, either the credit figured under the U.S. statute or the credit allowed under an applicable death tax treaty, if one exists. The U.S. has treaties with quite a few countries: Australia, Canada, France, Germany, Japan, the U.K., and others. Treaties often provide better relief, so always check if one applies.
Good tip. Okay, what about Schedule Q credit for tax on prior transfers? Sounds complicated, but beneficial.
Schedule Q credit for tax on prior transfers, TPT. Yes, this one can seem complex, but it's designed to prevent property from being taxed multiple times if people die in relatively quick succession. It applies if the decedent for whom this return is being filed, we call them the transferee, received property from someone else, the transferor, who died within a specific time frame. That time frame is either within 10 years before the transferee died or up to 2 years after the transferee died.
Wait, the transfer could die after the person receiving the property?
Yes, sounds odd, but it can happen with certain types of transfers, like remainders. The key is the timing of the deaths. The credit is potentially allowable for all or part of the federal estate tax that was paid by the transferor's estate on that property they transferred.
And the key wealth preservation point here is?
The key detail is that there's no requirement for the specific property received from the prior transfer to still be identifiable in the current decedent's estate. It doesn't even have to still exist.
Oh, really?
Really. It's enough that the property transfer was subject to federal estate tax in that prior state and the deaths occurred within the specified time frame. This prevents, say, the same family wealth being hit with estate tax twice if a parent dies, leaves assets to a child, and then the child dies just a few years later.
How much credit do you get? Is it the full tax paid before?
Not necessarily. It operates on a sliding scale based on how much time passed between the deaths. It's 100% of the calculated credit if the transfer died within 2 years of the transferee, before or after. Then it drops. 80% if within 2 to 4 years, 60% for 4 to 6 years, 40% for 6 to 8 years, and 20% if within 8 to 10 years.
And after 10 years?
After 10 years, no credit is allowed. The phased reduction reflects the passage of time and the diminishing connection, I suppose. Oh, and one more detail. If the transfer's estate chose to pay its estate tax in installments, under Section 6166, for example, then only the installments that have actually been paid by the time you file this current Form 706 are included when calculating the TPT credit.
Okay, based on tax actually paid. That makes sense. Phew. We've covered a massive amount of ground, from the basics to some really complex strategies. So let's try to wrap this up. What does all of this really mean for you, our listener, whether you're deep in estate administration right now or just thinking about future planning?
Well, I think this deep dive really underscores that Form 706 is so much more than just, a tax form you have to fill out. It's really a roadmap for strategic decision-making, decisions that can massively impact the financial legacy left behind. We've looked at those crucial high-level choices, right? Like electing alternate valuation to potentially capture market drops, or special use valuation to help preserve a family farm or business. We highlighted that incredibly powerful DSUE portability election, making sure you file Form 706 when needed to capture the first spouse's unused exclusion for the survivor. That alone can save millions. And beyond those big elections, we broke down the vital deductions for funeral costs, admin expenses, debts the decedent owed, those crucial marital and charitable deductions, plus that unique qualified conservation easement exclusion. And finally, we saw how credits like the foreign death tax credit and the TPT credit
provide that last layer of direct tax relief. Understanding these mechanisms isn't just about, ticking boxes correctly to avoid penalties. It's about making informed, proactive choices to preserve wealth, to ensure the decedent's wishes are honored efficiently, making sure more gets to the heirs and beneficiaries.
Absolutely. This deep dive really drives home that estate tax planning, or even just settling an estate, isn't a passive thing you do after someone's gone. It demands careful thought, proactive choices during the administration process, and often, yeah, getting good professional guidance to navigate all these complex rules and really maximize those wealth preservation strategies we've talked about. Every decision matters, doesn't it?
Yeah.
How you value an asset, which deductions you claim or where you claim them, which elections you make. It all ripples through the calculation and can significantly change what ultimately passes on. It really is about being an active steward of that financial legacy. So, as you sit with all this information we've unpacked today, here's maybe a final provocative thought for you to consider. If the ultimate goal of estate planning truly is to ensure your wishes are honored and your legacy is preserved for the people and causes you care about, how might a deeper engagement with these, yes, sometimes intricate tax details, actually transform your own long term financial vision? What new questions does this understanding spark for you? And how might it shift your approach, either to planning your own estate or perhaps helping an executor navigate theirs? Thank you for joining us on this deep dive.